This is not a millionaire maker stock. I sold out of an investment in my portfolio. If you've followed this channel, you can probably guess which one it is because I've kind of talked about it. But I'm in this game to become wealthy, not to play it safe and be careful, especially at my young age. Now, if you're older, if you're in retirement, that's different. But I do have goals and would like to become a millionaire someday, and that should be your goal as well if you still have a decade plus till you want to start taking distributions, retire, all that good stuff. So the stock that I sold is one that would have held me back, in my opinion, and that is Realty Income. Now, this is a very popular REIT for dividend investors who seek passive income. It's one of the few investments that pays a monthly dividend, and that's made it very attractive. And its yield is very attractive as well. It's right now about 5.6%. Of course, every day that fluctuates, but its stock performance over the last 5 years has been horrible. If you take a look at this chart, it is down 27% in the past 5 years, and over the last 10 years, it's only up 5%. That is horrible compared to the general market. If you've held Realty Income, you've massively underperformed. Now, I want to say, when I started investing, the idea of earning dividends was a fascinating idea. And when it started rolling into my portfolio, it's like you get a high off of that. So I started focusing on that solely, investing in only those high payers. But slowly and surely, year after year, I started noticing that I was underperforming others that were putting out content, or friends that have held portfolios that maybe had a little bit more knowledge than me at the time. And so I quickly learned that high yielding investments are there to offer stability, not growth. And I want growth. So that's why I sold Realty Income and made that change. And I've been changing my portfolio pretty massively over the last year. If you've been following this channel, there will be more changes to come. So as someone who is younger and strives not to underperform the general market, selling Realty Income, I am doing myself, my future self, a big favor. Now, it recently had a small little climb in its stock price, and that's when I sold, and I got out slightly in the green, which was pretty cool. And I'm going to share why I think I'm doing myself a huge favor, give you kind of the reasons why I think this is a bad investment if you want to become a millionaire. So I want to start off by saying, first, absolutely, or Realty Income, I keep saying but Realty Income because it sounds weird, absolutely does fit into certain portfolios. And those are investors that are seeking reliable monthly passive income, usually investors that are near or past the retirement age and actively taking distributions to support their lifestyle. That is awesome. This is the stock for you. Now, Realty Income is also a very conservative investment and conservative as a business as well. So therefore it's safer, less riskier. And they have paid out 655 consecutive dividend distributions and have increased the payout of that dividend over the past 109 quarters. But I will say some of those increases have been fractional pennies, so very underwhelming. Now, its long-term leases offer stability and are in retail industries that typically hold up well in all economic climates. 90% of its collected rent comes from businesses that are recession resistant and free of e-commerce disruption. They also hold a 98.7% occupancy rate that has never dipped below 96% in its entire history. So that right there is proof that if you are close to retirement or in retirement, this is a really good way to earn passive income, and I do not blame you for holding it. Outside of that, I think it's a different story. Those that have a decade or more till retirement, growth stocks are the strategy. They're the ones that I think are going to make you a millionaire, and that is what will best fit those types of investors. So those that do not need to take out distributions, that will also help save them on taxes each year, right? Because if you are young and investing in these very high yielding investments, many people don't even think about the tax side of it. And most importantly, you avoid losing out on higher returns overall on companies that are quickly growing earnings per share, revenue, free cash flows, and more. Usually, companies that pay out those high dividends have matured their business to a point where they are not taking on high risks or reinvesting heavily into the company or being super innovative or on a path towards innovation. Right now, AI is the big thing, and I'm going to talk about that in a second. Now, it is possible for a company to have so much free cash flows that they pay a healthy dividend, they also buy back a lot of shares, and they reinvest into their company heavily. But that's rare, and usually it's only paying out high dividends or reinvesting heavily into a company, into itself. And I like to think of Amazon. This company heavily reinvested into itself over the, I think from 2020 through 2023, maybe 2024, where they really expanded and built out distribution centers. And what this did is a lot of people saw that high capex, they freaked out, it tanked Amazon stock. But as an investor, you have to analyze and research and look at things beyond just a couple years. And what they were doing is setting themselves up for some future growth, right? And they have to have these distribution centers in order to fulfill same day delivery and be able to just fulfill the network of their customers that are all over the world, basically. And that was something that if you had that foresight and you just stuck to it like I did, it paid off, and it paid off massively. A company that is just taking their free cash flows and paying out dividends, they're not going to have that type of success. It's just different. So we're seeing the same thing with artificial intelligence right now. A lot of companies are reinvesting heavily into themselves, investing in AI. And I really do think that you have to at least hold some company in your portfolio that has a bright future with artificial intelligence. Of course, you have to choose a high quality company that will massively benefit from the reinvestments in AI. I like to think of Amazon, Microsoft. They're two I hold in my portfolio, but there's others out there. But you have to be careful, because if you invest in a small company that has higher risk, not everyone's going to win the AI race, right? Some of these companies aren't going to survive. But I think it's those high quality companies, the bigger companies with the monopolies, the wide moats, that have a clear advantage and a clear path with AI. Those are the ones that I think are going to offer the growth that we seek to become millionaires someday. So with Realty Income, real quick, I do want to say they're growing their AFFO and their revenue, slow rates, but they're growing. Long-term debt did spike up, but that was due to an acquisition, which in these high interest rate environments, I don't think you'll see much of this until those rates come down. And net income has kind of been a little bit all over the place, but it's growing overall, as well as AFFO per common share. Now their dividend yield is towards the top end now. It's ranged from a low of 3.5% to a little over 6% over the last 5 years, and right now it's at the higher end of the range. And some people might think, well, now's the time to buy. But you just don't go off of one thing. Just because the yield is high doesn't mean the stock's going to recover and that yield's going to go down. With the high interest rate environment, we don't know yet how much rates might be reduced this year, and you don't even know. Maybe it'll reverse and have to go back up due to some sticky inflation that might come back. So it's better to go off of the company's fundamentals and look at everything as a whole. And so though this is a very nice yield right now, if you're closer to retirement, it's something that definitely you should consider. But other than that, don't let that trap you in. Dividend trap is what they call it sometimes, right? Oh, it's a high yield, I'm going to buy into it. But yet a company may be growing very slowly and have some poor fundamentals. I'm not saying that's Realty Income, but a lot of high dividend, high yielding stocks, I've seen people pour so much money into them only to lose money despite a high paying yield. It's a dividend trap because investors, again, when I first started too, it's very exciting to earn dividends and see that money deposited into your account, but don't let that fool you, because it's the total return you want, not just the yield, it's the stock price appreciation as well. Now, Realty Income's price target right now, they're kind of in the slight outperform range, but I really think this company's a hold. They have a 15.5% upside potential. Right now, they're in the mid $50 range, and they can get up to the mid $60 range for the median and a high of 75. I think this year's going to be tough with the high interest rates will hinder REITs and their ability to create value through external growth, as it makes it more expensive for REITs to buy new properties. This also means that they would have to increase rent on their tenants, but unfortunately for Realty Income, their long-term leases exhibit minimal built-in rental growth. Also, Realty Income would have to take riskier acquisitions to create meaningful shareholder value growth, but then that defeats the purpose, because if you're at that point of retirement and wanting that passive income, you want stability. You don't want that passive income getting at the risk to a point where the company has to cut it or doesn't grow it anymore. So the high interest rates can also create headwinds for their tenants, and some of Realty Income's biggest tenants have been struggling with sales recently. Think of Walgreens. That company is a horrible investment. Think of Dollar Tree. They've been having a tough time. So you also have to look at their portfolio of tenants. I will say overall they have some strong tenants, but there are some weak links in there too you have to consider. So this is why Realty Income is not a millionaire maker stock. Don't get confused and tripped up with high yields. It's rather the investments that can grow their earnings per share, their revenue, their cash flows, and that eventually equates to the stock price growing massively. So Realty Income, it's a solid long-term income-oriented investment. It really depends, though, on your age and risk tolerance, like I talked about. I don't want to say this is a horrible investment, but I'm younger and I'm willing to take a higher risk tolerance with my portfolio because I want to try to become a millionaire, and that's what you should strive for as well. And stocks like Realty Income are going to hold you back. If we look at my portfolio, you will see here there's no more Realty Income in here. And instead, I have some growth stocks. You have Amazon, Microsoft, S&P Global, and Health Equity. These are my 4 growth stocks. Then I have what I consider 4 stable investments that still offer some great upside. Of course, I have the ETFs, SCHD and SCHG. I have Union Pacific, and I do still hold one REIT, Vici. I'm still very bullish on Vici because they invest in properties that offer experiences, such as properties on the Vegas Strip. They're expanding internationally. They are also into different diverse entertainment, such as bowling and golf resorts. I think this company has a bright future. I'm willing to hold on to it. It does hold a high allocation of my portfolio. If you look at Vici, down at the bottom, there's a blue number, 15.51%. That's how much it takes up of my portfolio. And it's in the top 3. The only other 2 that are higher are Microsoft and Amazon. So I don't plan on adding any more to Vici. Instead, I'm going to utilize this as a tool to take those dividends and reinvest in growth companies. So you can see my portfolio as 4 holdings are growth focused, 4 holdings offer more stability. And actually, let me revise that. That growth ETF, SCHD, that's growth. So I have 5 in the growth, and then I have 3 more stable, less riskier investments, because I still think you have to have some protection in your portfolio, but you got to be smart about it. I might not hold Union Pacific or Vici forever, but right now it's offering my portfolio some protection, I feel. And then on the bottom right, I'm going to add 2 more new investments, and you bet they're going to be growth focused. And overall, my portfolio's done really well. I'm up almost 40%. Now, I do show my yield information, so my yield on cost is 3.15%. That's how much yield I'm earning on this portfolio as a whole, and that's a pretty good yield. But I will say I started investing heavily during the pandemic. I wasn't scared. I was diving head in first because I luckily didn't let my emotions and fears take over. I just knew that the market would recover. This is a once-in-a-lifetime buying opportunity, so I think that really helped my yield. But overall, you look at Amazon, up over 100% for me. Microsoft, up almost 90%. I mean, these have done really well outside of the real estate. That's my only sector that didn't do well. And of course, I got rid of Realty Income, my weaker link, and I'll just hold one REIT for now. So yes, it is fun to get a dividend, but be very cautious because those high-yielding investments can be dividend yield traps or very slow growth. And if you're young, that's not what you want. You want the opposite. You want those companies that are innovating, growing their financials quickly, and expanding and creating this wide moat, the competitive advantage where no other company can come in and really hurt their business, that they have a strong defense field around them. I like to just talk about Microsoft, right? They have a dominant market share in the business world with their Office products. They also have the number 2 biggest cloud provider, Azure. They're now into gaming, which I think has a lot of opportunity. This company is well diverse in its offerings, a lot of growth ahead of this company, especially in the AI space. That's what they're going for next. And they're rolling out AI into their Office products as well. And companies are starting to buy subscriptions for that. That is great income. Those are the type of companies you should be focusing on, not a company like Realty Income just because it pays you a monthly dividend. Think outside the box. Think of your future. You want to become wealthy. You want to become a millionaire. So avoid investments like Realty Income unless if you're at that point of retirement. So let me know your thoughts. Maybe you have the total opposite perspective of me. I'd like to hear it all. I don't care if you agree with me or not. Let me know your thoughts. I hope you guys have a great day, happy investing, and work towards becoming a millionaire. We'll see you soon on Mark Arnold's Finance.